Hey, good morning once again, options traders. Well, this video is a little bit of a follow-on from some of the recent videos I've done on covered calls. And I had a trader email and say that he wasn't quite sure about some of these different calculations that I've shown and how to make decisions on which strike to write. And so I tried to simplify it and said that it really comes down to a time value hedge trade-off. And this is something that he said he had never seen before, so I thought it might also help the group as well. So what is a time value hedge trade-off for the covered calls? Well, let's go have a look. And as always, before we do, please be sure to click like and subscribe. It is very much appreciated and definitely helps to promote the channel. So as a quick review, the covered call. It's a strategy where you're going to buy 100 shares, or maybe you already have the shares in your account, and you will sell one call against those shares. But it's always done in a 1-to-1 ratio. So if you had 200 shares, you could sell 2 calls, 500 shares, you could sell 5 calls, and so on. That's what it means to be in a 1-to-1 ratio. And when you sell this call, it creates the potential obligation to sell shares for the strike price. It's not a guarantee because it's up to the person who bought the call to exercise and actually take those shares. Now, once you sell this call, you will, of course, receive cash. That's what happens when you sell something in the markets. You're going to get cash for it, and this cash from the sale of the call creates a downside hedge. Because had you not received that cash, let's say if the stock falls 5 points, you'd be down 5 points. But if you also collected $5 from the sale of the call, you would just break even. And so that's what it means to have this downside hedge. It's just a little bit of a safety net if the stock price happens to fall. So always remember, whenever you use a covered call, your outlook is neutral to slightly bullish. You are not bearish. That's another mistake that traders make. They'll say, well, I heard when you sell a call that you're bearish. Well, that's true if you're selling the call by itself. That's not what's happening here. You are long shares and short a call, and that greatly changes things. So let's say that you bought shares for 100 and you sold the $100 call, the at the money, for $5. This would be your risk graph. So there's our bend that we always talk about right at the strike, lines up right there at 100, and the maximum gain is right here at +5. So in this case, all of your gains are coming from the sale of the option. So notice that you bought shares at 100 and you sold the 100 call. So you have the obligation to sell for 100. There's no potential for capital gains. So once again, all of your gains are coming from the option's extrinsic value. But you still retain all of the downside risk below this break-even point. So you can see that this break-even point is shifted lower a little bit. Had you just held the shares, you'd be breaking even at 100, but now you can break even at 95. But what would happen if you sold an in-the-money option? Let's say you sold the $90 call. You're going to shift from the black curve to the green. So the first thing to notice is that your downside hedge is increased. And that just means you can afford to have the stock fall further and just break even. You still maintain all of the downside risk below this break even, but also notice that you've given up more of the gains. This green line doesn't sit nearly as high as the black line. And that's because it's a risk-reward trade-off. You have opted for more of a safety net, more of a downside hedge in exchange for lower rewards. This is just a risk-reward trade-off in the markets. Now, what would happen if you sold an out-of-the-money option? Let's say the 110 strike. Well, now you might move from the green to the red. Here we've got our bend right there at 110. So notice that the break-even point is really not affected all that greatly. So here is the break-even point where the red line crosses 0. And there is the current stock price right there at 100. Not a very big gap between those. So you didn't really do a whole lot for the downside hedge. And that's because an out-of-the-money option is going to be relatively cheap. You didn't receive a lot of cash. But because you sold an out-of-the-money option, 110 strike in this example, yes, you do have the ability to have a much higher capital gain. But you're still also retaining all of the downside risk. So once again, the important point to notice is the trade-offs here. If you want a good downside hedge in green, you're not going to get a lot of reward for it. If you're trying to get a ton of reward, you're not going to get a very big downside hedge. The markets are not going to allow you to get a really big downside hedge and also get a big reward. So the whole decision comes down to what are you looking for subject to what the market is offering for prices. So a common mistake that traders make is to just simply sell far out of the money options. And they do this because they're fearful of selling their shares, as if for some reason that's bad. And in exchange, they receive very little premium and therefore have a very small downside hedge. But they do cap the upside gains, and they still do hold all of the downside risk. So once viewed in this light, you're just thinking, well, what's the point? Why do it? We're sealing off the upside gains. We didn't really get a big downside hedge, which is the main reason for doing a covered call in the first place. And even if we do end up with lots of gains, we would have had those whether we sold the call or not. All of these gains from an out-of-the-money option are primarily from movements in the stock, not from the sale of the option. So what are some things that you should consider when you're choosing between in-the-money versus out-of-the-money? Well, if you sell out-of-the-money calls, again, you will receive very little premium. And that means you have a small downside hedge, but of course you have a potentially very large possible gain. But if you sell in-the-money calls, you will also receive relatively small premiums in terms of the extrinsic value. But because you also receive a lot of intrinsic value, it creates a large downside hedge. So notice the symmetry here. If you sell out of the money options, you're going to get a very small amount of extrinsic value, relatively speaking. And if you sell in the money options, you're also going to get a small amount of extrinsic value, but you're also going to get a lot of intrinsic value. And so this is really what the whole decision comes down to. It's all based on your goals. So the thing to understand is that there is a price symmetry in options. Now for the covered call, it's just looking at calls. So let's look at the call price symmetry. If you're looking at your quote board, as you move in the money or out of the money, there is a pricing symmetry. The extrinsic value for $5 out of the money will be roughly equal to the extrinsic value for $5 in the money. That's what I mean by symmetrical. You're looking up and down that quote board. So if you go $5 in the money or $5 out of the money, or $10 in the money or $10 out of the money, the extrinsic value will stay roughly the same. So in the money options also have intrinsic value to add to the downside hedge. And of course, that means that it's going to leave no room for capital gains. So once again, this is the trade-off. So to see it clearly, let's do it first with a pricing model, and then we'll jump over to a broker's platform and take a look at some live prices. Okay, so now we're into an Excel spreadsheet, and we're looking at the strike price, $100 call. This is the at the money, and we have it broken down into intrinsic and extrinsic values. These numbers are all generated from a pricing model. I believed I used 25% volatility, but it doesn't matter. You're going to get the same outcomes, just different prices. But let's start with the at the money. The option is worth $286, so it has $0 of intrinsic value, and all of its value is derived from the extrinsic value. But let's just pick a number. Let's go 5 points in the money. You can see that the extrinsic value is 97 cents, and if I go 5 points out of the money to the 105, it's $1.08, but not too far off from 97 cents. The difference is that the 105 strike has $0 of intrinsic value, whereas the 95 has $5. So see, if you sell the $95 call, you're going to receive almost $6, $5.97. And so that's your downside hedge. The reward is 97 cents. But if you sell 5 points out of the money, you'll receive almost the same amount of extrinsic value, $1.08, but that's the size of your downside hedge. So again, this is really the trade-off. So you can see that as you start picking different prices, if we look at 42 cents of extrinsic value, I should be able to find that for an out-of-the-money option. And right there is 42 cents for the 109 strike. If I want to find one that has 30 cents of extrinsic value, right here, the 91 strike, down here, the 110 has 32 cents. That's what I was talking about, the symmetry. Whatever extrinsic value you want to find on the in-the-money side of the board, can roughly be found on the out of the money side. Now, this is, again, a perfect situation because we're working with a pricing model. In the real world, you can end up with skews where they're not going to be as symmetrical, but at some point, you will find those, or at least roughly close to those same extrinsic values. So now with that background, let's jump over to the ETrade platform and take a look at some actual prices. Okay, so now we're into the ETrade platform. I'm just going to use NVIDIA, and I'm just going to pick an expiration. Doesn't really matter. If you're too close to expiration, you're just going to be dealing with either zero or intrinsic. So you want to be sure that there's at least some time until expiration. So the stock is trading for about 183. So the at the money based on the extrinsic value is right here, the 185 strike. It has the largest amount of extrinsic value at 1172. So take a look at the symmetry first. If I find a price, let's say up here with $4.72 of extrinsic value, I should be able to find about that much on the out of the money side. And right down here, about 457. If I want to find $2.30 up here on the in the money side, I should be able to find about that much out of the money. If we come down here, somewhere between this strike and this one, you've got 265 versus 201. If I'm willing to take $1.41 of extrinsic value for a reward, right down here is $1.49. So I can always find the same extrinsic value, or at least roughly speaking, but they will have very different intrinsic values. So really the whole decision that I was explaining to this trader is to say, you have to come up with a goal. If you're buying this stock and writing calls, remember, you can't have it all. You can't have a huge downside hedge and a lot of extrinsic value. We have to take what the market is pricing right here, what it's giving us. But let's say that I'm more fearful of the downside. I might say I would really like to have a $10 or $12 downside hedge, in which case I could come down here. Here is the mark. That's the total price of the option. That's $11, but there's no intrinsic value. Now, this just happens to be a fairly good size downside hedge just because there's a lot of volatility. But let's say I wanted more of a $40 downside hedge. Well, there's $40 for the mark. That's what I would receive for selling that option. But I'm only going to get about $2.33, $2.34 of extrinsic value. So now I have to say, is that adequate? Is that going to meet my goals? I could also work it in reverse. If I'm willing to take $5 of extrinsic value, I could either come down here and say there's roughly 5. I could either get a 27-point downside hedge, or I could come up this way and get 5 with no downside hedge, but a much bigger potential capital gain. So notice that I'm focusing on the goal first. Are you either after a certain sized reward, in which case try to balance it against the mark, the total value that you're going to receive for the option, and therefore your downside hedge? Or are you more interested in the downside hedge, in which case focus on the option's total price, the mark, and then balance that against the extrinsic value? Okay, so let's try one more. Let's say that for my goal, and for this amount of time, 32 days until expiration, I would like to have $5 of extrinsic value, $5 on a $182 stock. So I could either say, well, I can get roughly 5 of extrinsic value here, but I've got a $27 downside hedge. That's one choice. But then I'm going to have nothing else for a gain other than this roughly $4.86. But I could get that same amount down here. Here's 450, here's 582. I'd kind of have to make a choice. Let's go to this one for 582, but now that's not the most I could ever make. It is the biggest downside hedge I'm going to get because that's the mark, but I also have the potential for capital gains because this is the 200 strike. And with a stock at 182, that's another potential $18 I might make. But see, that's far from guaranteed. So what we're doing is we're trading off the downside hedge in exchange for potential capital gains. But that's really what the whole trick comes down to when you are writing your calls. What you don't want to do is just scroll through, find the furthest out of the money one that you can for 50 cents and say, look at the maximum gain I might get, and therefore I'm never going to sell my shares and completely seal off your gains, get no downside hedge and no return, but yet take the risk. And so for any of you who are using covered calls, I hope that gives you a little different perspective of really the two things that you should be looking at to try to balance. It's the trade-off between the intrinsic and the extrinsic values, and therefore the size of the time value or your return versus the size of the hedge. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.